Welcome everyone to the Fund Manager panel at Distributed 2018. My name is Bril Wang, the founder and partner at Cardinal Pitch Club. So it's a 2,000-member Stanford alumni and local entrepreneur organization. I also represent another two organizations here. One is Cryptic Labs. It's led by Wilfred Diffie, the father of crypto, and another two Nobel Prize winner in economics, and 10 more professors in cryptography, distributed systems, homomorphic encryption. And the second organization is called the Stanford DTI, Distributed Trust Initiative, where you can find more information at cryptolab.stanford.edu. Today, I'm very excited to have our start panel here. Jehan Chu from Kenetic Capital, Zhen Cao from JD Capital, and Fang from Sora Ventures. So I would like to hand it over to Jehan and the rest of the panel to give a short introduction of yourself.
Sure. Thank you, Bril, and thank you, Distributed, for having us. My name is Jehan Chu, and I'm the co-founder and managing partner for Kenetic. We are a institutional platform for crypto and blockchain based in Hong Kong. We're about 55 people spread primarily in Hong Kong, but also in San Francisco and Singapore. We focus on building technology and providing technology services to blockchain companies. We focus on tokenization advisory. So we've launched a number of ICOs, including AirSwap, Simple Token, and Bluezell. And we also have an asset management arm where we invest in everything from early stage blockchain equity to crypto with a long bias, as well as hedge and trading. And we also have a community arm where we have an event coming up called Nifty, which is an NFT and gaming and collectible focused conference next week. So that's the short intro. And again, happy to be here.
Sure. Jen, please.
This is Jen. I'm with JLab, which is the subsidiary of JD Capital, and it is a $9 billion AUM fund, and it's the only public traded P fund in China as well. So JD Group, which is a large conglomerate with security exchange, banking, and insurance companies. And then for JLab, which is we more focus on crypto and blockchain, we both invest in equities and token. So we invest in over 50 portfolios right now, and we invest in ontology, Thunder token, Oasis, some academic ones, and also we invest in some basically full spectrum, like exchanges, media, ticker, wallet, like Kcash, which is the second largest wallet in China, and also my token is the largest ticker with 1 million users in China as well. So I'm mostly based in San Francisco, come from traditional VC. Yeah.
Hi, my name is Fang, managing partner at Sora Ventures. We're an Asia-based VC fund dedicated to cryptocurrency and blockchain technology. My background is I was one of the early employees at Fimbushi Capital, so started doing Bitcoin and blockchain equity investments. And I started Sora Ventures when China banned ICO, and the fund is mostly dedicated to family offices in Asia. Our fund strategy is one we incubate in Asia, and usually our projects are one project every 6 months. And then the first one we did was with Mithro. It was just backed by 17 Media based in Taiwan. The second one we're doing right now is called Alpha Slot, which is backed by the 3 largest families in Macau. And we usually do things that are, well, there's 3 criteria. Number 1 is a reverse ICO, which is an equity company launching a token as a strategy. Number 2 is application, and then back to protocol, and then back to application. And that's quite different from a lot of the projects we see in Silicon Valley, which is more focused on scalability. And number 3 is usually the equity companies that we're working on is usually, their operation is usually non-existent or banned in China. So that gives us almost like zero legal barriers. So if you're familiar with the Chinese market, in the past there was a company called Meitu, which is a listed company in the Hong Kong Stock Exchange, that started doing something called Beauty Chain. And after like 2 weeks of launching it, they got stopped by the Chinese government, and they were forced to basically come up and say that there's basically no connection between the ICO project and the IPO. And that basically failed after. So we don't touch anything in China, even though we're Asia-based. And our office includes Hong Kong, Shanghai, Taipei, and we're currently looking into expanding in Korea right now.
Thanks, Jason. Now we can go back to more general questions. So the first one I want to ask the panel is, since last year, many projects has canceled their ICO, and now only the fund managers has the opportunity to invest in the private rounds of those token projects. So I want to understand, what's your opinion towards this trend, and does that elimination affect the decentralized nature of token sale participation?
Yeah, so sorry. Yeah, so mostly the reason why they have only for pre-sale investors only is because a lot of them are security token right now. That's why one of the rules for security token is you need to have like 1 year lockup and then to be responsible to the retail investors. And then so one solution, so it's actually against the original intention for ICO of redistribute all the voting power to every investors, to every like the mass adoption, right? But then the solution can be you can have the product first, and then like as SEC has been talking about, there's an example of if you are launching a laundry token, do you have your washing machine ready, right? So mostly this can be a problem solver by you can issue more utility, like true utility token before the ICO, and then you're able to sell to more retail investors.
So you mean like the ICO after you have like the utility available? Is that right?
Before the
Before
ICO.
Before
yeah.
ICO.
Mm-hmm.
Okay. Does any of the other?
Yeah, I think also, again, it really boils down to the regulation and the lack of kind of clarity in terms of how the SEC is actually classifying a lot of these tokens. It's really a defensive measure, and I think a wise one from a lot of the projects out there. So for all of you who are thinking about issuing your own token sale, this is a way to have a slightly more, kind of defensiveness and defensibility for your project if you're launching. But I do think that it's a temporary phase that we're in. I think that we will, with regulatory clarity, which we hope will come in the next 6 to 12 months, projects will know where they stand with the SEC, and they'll know what they need to do in order to compliantly issue tokens and utility and security. So it is a shame that the world is becoming much more about the people on this stage and much less about the people that are out there in participation. But I think that it is temporary. But I also think in some ways it's not a bad thing. I do think there was too much kind of mainstream speculation and not enough education in the market. And so maybe this is not a bad time for everybody who's been speculating and just who's down 50, 60, 100% to take a beat and just learn a little bit more. And it's not a bad thing just to kind of have the market take a breather before we restart with more clarity.
Thanks, Jehan. Our second question is here. Sorry, I'm running a little fast because we only got like 20 minutes here. So we are seeing projects nowadays. They have designed like different fundraising rounds, angel round, and then cornerstone round, and then private rounds. And what is your opinion on the fundraising timeline rounds? And what is the what about the valuation difference? Like the angel round could be like, the cornerstone round could be like 1 times higher or 5 times higher, and a lot of people are talking about, previously you guys may have the read the news of Doi from Danhua, like the 5 times increase from the angel round to the private round, and they're saying that they're taking advantage of that. So what is your opinion on the timeline, and what do you think? Yeah, go ahead.
I think the U.S. and the Asian ones are quite different. I mean, number one, you have to look at the nature of what the project is. It really differs depending if it's a protocol or application. Whereas in Asia, for example, the projects that we incubate are mostly starting off with application. Where if you're doing protocol right now, it is because we're also in a very bearish market. I think the investment strategy right now is to do really, really well in the primary market. And that's how a lot of the top VCs basically secure their interest from a very early stage on. I don't think it's necessarily a bad thing. I just think it's how VC makes money nowadays. Because if you look at the U.S. market like a year ago, you would have made 10x return every 2-3 months, and it's quite liquid. Nowadays, it's very different. And I think if you do the same strategy, you're gonna actually end up losing a lot of money. And right now, the appetite for the market, unfortunately, is just pure protocol. And I think it's going to hit a point where I think a lot of these protocols are going to fail. Not saying that it's bad, but I think realistically, if we're venture builders, we're investors trying to really improve the market, I think you should still look at things that are more practical, like application. And that's why we go with a more application prototype and then a protocol and then back to application. But I think in terms of answering your question, I think this is how a lot of the top VCs make money, because you have to start from round 1 and then second round, and third round, and then the fourth round. And then when you hit the 5th round, then your valuation is so high, and then you get listed, you're like top 20. But the problem with that is obviously you have very, very low liquidity. And that, if you compare, for example, Tezos, which is like top 20 right now, compare that to Quantum, it's like 1/10 or 1/20 of the volume.
So what is a healthy ratio there, like in terms of like the angel round and then the private round? What do you think? Like taking into consideration the protection that the early stage investor have to have, is it 10 times or 5 times? What is the sweet spot?
I don't think there's a number for it, but what I can tell is there's just less whales out there. There's just less. Well, in China, there's a term called chive, which is basically retail investors who basically buy in the secondary market, and then that enables us as primary investors to exit. There's just less of these investors out there, and I just came from Korea. It's just very interesting. Most of it's quite. A lot of people thought it was very optimistic that the Korean market is doing so well on Bithum and Upbit, but if you talk to a lot of Korean exchanges and a lot of Korean VCs, you realize that the housing market is actually doing really well, and and the crypto market is not doing so well. So it's very clear, like a lot of people sold their crypto to buy real estate.
All right, thank you, Jason. And the third question on here is, when investing in early stage projects, do you guys prefer to collaborate with other funds, or do you prefer as traditional VCs, Sequoia or USV? Most of them they take in a round by themselves. But token fund, do you see a difference, and which way do you prefer?
Yeah, I think that it's quite important for investors to collaborate. At Kenetic, we love having our friends and other people also participate. We actively invite people that other trusted investors into the rounds. I think that when we see these rounds where there's just one party who takes the entire round, that actually makes me a bit worried. Not only because there's a concentration risk there, but also because the type of vetting, the type of exposure, and the type of endorsement and support that project can now get is limited to one party. Our world is one of network effect. It's one of community, and it's one of like collective action and collective support. So I think that extends to the investment side as well. And so I really like it, when we get to collaborate with like our friends, on stage here and invest together. It gives me a lot more confidence. It gives me a lot more looks into it. I can also share our own views and our own research. And ultimately, I think that the project and the community, like the wider community, benefits from having more eyes on it.
Right. I think most of the crypto fund manager and the funds will open for collaboration because of variety of the endorsement. And just like for Jason, they more like focus on adoption, and for Jehan, it's like the long time crypto experience and like design mechanism, those stuff. And then I want to bring back a little bit to the last question. So basically, there's a model being promoted by Vitalik Daiko. So that is basically after you raise a 30 million, and then you need to like for investors, I can actually supervise on this project, because if you release the 30 million total, they're gonna lose the momentum. But if it's go back to the traditional equity, if you hit a milestone and you can release it, you can have the Series A funding, and the milestone B, you get the Series B funding. So that is a better mechanism instead of you get in like a lot of structures in the pre-sale, right? So there's no fundamental differentiation after 2 months of your product development and the business partnership size. The only differentiation is timing and or like geography, advantage, right? So I actually not supportive for that. If I found out a project early, I would love to everyone to get in the same round. Yeah.
But you only have that amount of allocation, and who is your ideal partner if you can get, other than the other two on the stage?
Yeah, of course, like every geography leaders, right? So if I found out a really good projects, I want to find out who's the true community builder, who's the true, like, really thoughtful about the technology, the engineer in that geography, like let's say like Singapore, right? So like find out the strategic geography leaders will be my first thought, and also the one who's good at community technology, and yeah, like all the verticals. Like there is like one vertical that a fund is really strong at.
That brings up to our next question, actually. So, as the token funds became more and more global, how do our panelists will, how important do you feel you are going to maintain as a geographically dominant fund? So, like in Hong Kong or Shanghai, like, what's your opinion?
Yeah, I mean, although we're based in Hong Kong and we started off in Hong Kong, we've made over 100 investments just in ICOs. And I would say that more than only maybe less than half of them are actually in Asia. So I think most of the funds out here, you go where the good products are, you go where the good founders are,
That's
you go
right.
where the good teams are, and we've been kind of global in a sense to start. We do obviously have a better network, I would say, in Asia than we do in other, say, in Eastern Europe, for example. But I think that most funds are global by necessity at the moment. And I think that will, just kind of continue. I think also it's interesting to see that a lot of the Western funds, or a lot of the funds in the US and Europe, seem to be spending a lot more time in Asia these days. Maybe that's because that's where a lot of the kind of investment and liquidity is. But we're also seeing this kind of almost this backflow, which is quite interesting.
Yeah, so at the early stage, like there's the argument saying, before you have Google and then the China Google, which is Baidu, and then here you get Amazon, and in China you have Alibaba, and now at the early stage, the projects are starting to become global at the very beginning. And my next question is like the traditional VCs, they take the LP positions. So I want to understand how this token fund works. So do you guys take LPs, and what's the management fee and carry structure different from the traditional?
Jason, you go
This is a
first.
very sensitive question.
Exactly.
Our fund is 100%, like the Sora Foundation, Sora Ventures. We raised about 30 million in February 1st. 100% of the money is from our LP, so I have zero interest in the fund personally, but 80% of our LPs are family office that never, or managing partners at VC funds, never touched cryptocurrency before, and their first investment is in Sora Ventures. And we usually go with kind of a standard which is quite similar to Pantera Capital. I think is 30 plus 3. That's what we have.
So 3% of management fee.
Yeah,
and
and our
30%
minimum
carry.
investment check size is $1 million USD.
Yeah, for us, we take LPs, mostly from the LP of JD Capital, and then some enterprises, wealthy individuals, family offices. And so our structure is actually flexible, so it decided by our return, yeah.
Other than a small kind of friends and family thing that we did at the very beginning, where Kenetic operates on its own principal capital, so we actually don't have any LPs yet. We do have plans to raise outside funds for our hedge fund, for our long-only fund, for the next kind of iterations of that as we expand our business. But at the moment, it's all kind of just playing with our own money. As far as structure and fees, I think we are more thinking of more traditional 2 and 20 kind of structure, but it'll be interesting to see how the kind of different fee models evolve for the space. I remember that in the early days when the first few funds came out, it was even much more than that because those are the days when people were typically getting 10, 20x on their returns, and so higher fees were justified. But now the kind of margins are kind of slimming down. There's a lot more misses than hits. And I think that it will be hard to kind of maintain those higher types of fee structures. And so it'll be interesting to see how that evolves over time. My guess is that it will converge to the normal VC standards of 2 and 20, but if you're making money, then you're always going to find people who are going to kind of pay you to do that. So we'll see.
And plus, because we're like more of a hedge fund actually, so we're open-ended, Cayman open-ended fund. So we're like a hedge fund structure, but operate like a VC, and just because cryptocurrency is so liquid.
And in terms of the survival of the fund, for VC is probably 9 years, 7 plus 2 plus 2. So what how long is your fund? What's the survival period?
We're actually evergreen, so we're open-ended, which means that we can take money every month. But the problem with some of these hedge funds is if we bring in more money, which actually we have a list of people who want to invest in us, it actually dilutes the shares of existing investors, where we, in addition to a lot of the incubator projects that we have in Asia, we're also investing in long-term projects that focus on scalability. And those projects, basically, if they're not listed, then new investors will get basically the same benefit as existing investors that, let's say, invested 5 months ago. So that would be a disadvantage for early investor who invested in Sora Ventures.
Yeah, like how soon do you distribute that profit back to them?
What do you mean how we distribute
Like,
profit
are
back?
you going to calculate maybe like for example like a VC fund, you get exit when Uber get public, right? Like in 7 years, 9 years. Like what is the term that you put in like Sora Ventures? Like after 3 years, are you paying them back? Like how long are you going to keep their
Oh,
capital
okay.
for?
So we have a lockup period of 6 months plus a redemption period of 3 months.
Awesome. Next question is still to Jason. So we see some people have the theory of the earliest mass adoption of blockchain will be in the entertainment such as music, video, gaming, etc. Just like what happened to the internet. So what is your opinion? And because we see like out of the 13 portfolio companies you have invested for, all of them that are entertainment related. So the Meteor you talk about, and also now Alpha Slout.
Yeah. So obviously, my background again, I used to work for Fumbushi, so we've been investing into blockchain equity investments for a long time, and my experiences with equity investment is obviously there are some industries that are relatively conservative. I guess the key word is relative, right? So there's healthcare and there's the financial service. These are hard to integrate. Whereas I guess equity, crypto investments, entertainment, things are actually gray area. Even like pornography, for example, those are usually quite easy to integrate, and it makes a lot of sense. I think it's also because there's just a lot more flexibility, and by chance we end up meeting kind of the entrepreneurs we end up working with. And some of them also operate businesses that are considered gray area. And apparently these are real use cases that can be integrated quite easily. It's just a matter of, I think it's just a matter of how aggressive you want to integrate it, because eventually, let's say if you're doing porn, for example, you can only work on certain jurisdictions. Whereas if you're doing, let's say, financial service, this model can work anywhere on the world.
I'll just add to that because I think the gaming and entertainment is really important. I think that CryptoKitties really showed us like what's possible in terms of mainstream type of appetite for blockchain applications, and I think that we were just in Korea, and there were like a number of Korean gaming, really major gaming brands out there who are all actively getting into this space. So I think that gaming will kind of prove out to be one of the most important and really kind of watershed moments for mainstream adoption of crypto, where we're actually seeing it being used, where we're actually seeing it generate value. And I would guess that would be within the next 6 to 18 months. And so we won't have to deal with this question of like, oh, well, blockchain doesn't really do anything yet. There's no real applications. I think that those first kind of movers will be in the gaming space, and we really drive the rest of the kind of value proposition for other industries. So that's kind of why we're also doing like this nifty conference. We want people to be thinking about gaming and collectibles specifically, in developing applications and meeting each other and developing concepts.
Yeah, so we're seeing, the JLab is basically having the same view. The founder of Sun Jian has, giving the forecast, on gambling, also on financial products. So I also want to learn about JLab. Like what's your focus for the next 6 months or so?
Right. So for me, I'm all about adoption, and then there's a few verticals, right? So first is store value, which is Bitcoin, and then second is medium exchange, and it could be the in-game currency inside of game, and then third is financial contracts, right? Like debt like lending, credit, and margin trading, or any of the financial products. And then, so for us, yeah, we invested in Cocos, which is one of the largest game engine in China, and then they doing the reverse ICO. And then, so I also come from the gaming background. I was on the investment team for content in HTC Vive. So we're working with Star Wars, Star Trek, and Square Enix, those titles, and even Westworld for HBO. So the reason why is it's a lot of IP, just like Jehan previously mentioned that all those game companies that they have the traction and they have the IP and they have the distribution channel already. If they look into crypto, that could be a very interesting like adoption vertical for blockchain. Yeah.
Awesome. Yeah, so I think we only have 3 minutes, so I want to jump to this question, which I'm personally very interested. So, how important is market making and pricing, strategy to crypto projects, and what is the advantage of a fund or a token project itself to to host like a market making team itself, and probably Jihan already have like internal market making team, and probably like the rest of the panel are collaborating with some market makers. So what is your point of view?
Sure. We don't actually have an internal market making team. No, so we trade ourselves. So we have a trading team, but they're not market makers per se. And I think it's also important to understand the difference between traditional market makers and what we think of as market makers in the crypto space, because they do relatively different things. But for us, we have traders that that actively trade, take positions, long, short, momentum, et cetera, arbitrage. But they're not. We don't have a specific market making team ourselves.
So for like early stage, when they just listed, for example, on Binance or Huobi, this like market making is one of the key component, right? Like as what I've been told, to increase the liquidity, to give confidence to the market. So like Jason or Jen, do you guys have any opinion on this? What like how do you view?
Yeah, we actually do have a trading team, like for arbitrage and all those like normal ones, and we also like provide liquidation for the projects. I do notice that right now the secondary market performance is unrelated to the product development at all, right? So if there's something liquidity enough, and then people just gonna go towards there instead of a really good projects. Don't spend money on market making. So I don't really like this like environment because it's unhealthy for the people who's like making real products to the whole space, and then but of course to figure out the strategy of getting the real users to engage with your products and then to really care about your roadmap is more important than purely liquidation management.
Yeah, we don't have an in-house market making team, but what we have noticed is in the Chinese market specifically, because the product is so driven by, actually realistically, the team and the product, everything is so driven by investors. There's almost like it feels like a scam. So the market making is actually quite important in the Chinese projects, especially when they get listed, and you basically need to have a lot of ammunition to support in the secondary market. Whereas we try to stay away from that. So even when we're incubating projects, we try to find real use case that can be integrated with real product, so that basically we're introducing cryptocurrency to the average Joe without having them to actually understand this cryptocurrency. I think that's where we're going. So hopefully that's a direction that requires less, let's say, market makers, because what we've noticed is even if you get listed on, let's say, I think Mythro got listed on Bithum and it went like crazy in the market. And we don't know why, but recently we found out there was a story behind it, because one of our partners, so we have a Sora Ventures and we have a Sora Foundation, which does community development, conference, and in-house blockchain technology development, and one of the co-founder is the organizer, the economy, and somehow he used to be one of the first employees at R3, and people thought that was a very significant thing. And so Sora Foundation was listed as one of the partner for Mithro, and people started to relate that to Jeff Peck, and then that went up crazy. And there was actually a Korean post on the blogs that said this, and people think it's because of that drove the price of Mithro up. But I really don't know. Even today, it's still a mystery.
Thanks, Jason. Yeah, I actually want actually the time is already out, but I want to add one more question because nowadays, like we're seeing a lot of funds are forming, like token funds. So I want to learn about your suggestion to the new funds. What would you have done if this is your first time investing in token?
Figure out an entry barrier, like basically have your one specific like upside than any other ones, right? Like some funds focus on hiring that they have a Google, Facebook, like engineer database that they can be helpful on every project that they invested, that they grab from the database, stuff like that. Figure out a specialize in one vertical. I think that would be very important.
To be honest, I think it's kind of tough for Silicon Valley investors to make money unless they come in the second round or third round. It's really hard in the secondary market, especially when it's very bearish. And there's a lot of people who has a lot of token and a lot of interest from round one and round two. I think I think you basically need to focus more on incubation. I think incubation at this point is a lot safer because you have more control of the direction of how much interest you have in fund. But more importantly, and when you're incubating it, you really do understand, you really end up what we call understand the risk behind it. I think if you can focus on that, that's pretty good. And usually, in our fund, we only have 13 portfolio companies, but we lead a lot of the companies that we invest in, and our check size are usually over 3, 4, 5 million USD. So those are turned out to be quite successful for us.
I'll just add one last point. I think that if you're thinking about starting a fund, it's important to not just think about, oh well, how do I choose the winners? Think about how you can add value in the long term to projects, to founders. Like figure out what are the problems that founders have these days. It's a very nascent space. There's a lot of things that we don't know. We don't even really know what the end products are going to be in this industry. So there's so much opportunity for all of us to kind of take our own individual skill sets, our own individual expertise, and add value that way. So if you can figure out what how you can benefit these projects and these founders, I think that's a really good way to start. One of the things that we found, even in our own business, we're continuing to create new products and new services. Is we did a meetup the other day around treasury management, and we're just interested in how to help projects think about their own finances, stuff like this. There are many different needs that projects have, and I think that if you just dig down and see like what am I good at that could help, that's a really good place to start and a good reason to start a fund.
Well, thank you so much, our panel, for sharing your opinion. I would like to conclude here. Thanks for everyone for listening.